You have one opportunity this year that you may never get again. And if you wait until January, you could lose out on thousands of dollars in tax deductions. And I don't say that to be dramatic. Starting January 1st, 2026, the rules around charitable giving change in a big way under the One Big Beautiful Bill Act. Only donations above 0.5% of your income will even count as a deduction. And if you're a high earner, your deduction gets kept at 35%, not your actual marginal rate. So if you normally give $10,000, $50,000, even $250,000 a year, these changes directly affect you. And more importantly, they affect the impact you are able to make on the causes you care about. And now we're in the final few weeks of the last year where these favorable rules apply. So today, I want to walk you through what's changing, why it matters, and the smartest way to give before December 31st. To protect your deduction and maximize the impact of your generosity. Let's start with the actual rule changes, because this is what creates the urgency. Beginning in 2026, the first big shift is the new 0.5% adjusted gross income floor. That means if your adjusted gross income is $400,000, the first $2,000 of your charitable giving gets zero tax benefit. If your adjusted gross income is $2 million, the first $10,000 gets no deduction. So for many families, smaller annual gifts simply disappear from a tax perspective unless they give at scale. The second shift is the 35% deduction cap. Right now, if you're in the top tax bracket and you donate $100,000, you might get $37,000 back in tax savings. In 2026, that same gift maxes out at 35%, and only after you clear the adjusted gross income floor. So even if your generosity stays the same, your deduction value shrinks. And here's the part most people miss. 2025 is the final year under the old rules, and we are now in the last few weeks of it. The window is about to close. The incentives are better, the deductions are larger, and the strategies you can use are more flexible. This is the month to be proactive. Let me show you what this means in real terms. Take two families. Both give $50,000 a year to charity. Family A does nothing special. They write checks from their bank account every year. Family B uses the strategies I'm about to show you. By 2030, Family B will have saved over $75,000 in taxes compared to Family A, just by being strategic about how they give, not how much. Same generosity, completely different tax outcome. Let's make sure you are Family B. Let's begin with something I say all the time. Stop writing checks to charity. I know it feels simple, clean and familiar, but from a tax standpoint, it's one of the least efficient ways to give. Here's why. When you write a $10,000 check, you get a deduction, and that's it. But if you donate $10,000 worth of appreciated stock, everything changes. Imagine you bought a stock years ago for $20,000, and today it's worth $50,000. If you sell it, you've got a $30,000 gain. For a high-income household, that's 20% federal capital gains tax, 3.8% in net investment income tax, plus potential state taxes. You might owe $7,000 to $10,000 in taxes on that sale, or you could donate the stock. When you donate it, you avoid the capital gains entirely. You get a deduction for the full $50,000, and the charity receives the full amount tax-free. They are tax exempt. They don't care about your capital gain. This is why wealthy families almost never write checks. They donate directly from their portfolio, and you should too. And because markets have been strong, you likely have positions with meaningful gains that make perfect charitable assets. The only timing note: stock transfers usually take 3 to 5 business days, sometimes longer near year-end. So don't wait until late December. Now, let's talk about what is probably the most important strategy of 2025. Donor Advised Funds, or DAFs. A DAF lets you make a large charitable contribution this year, get the full deduction this year, and then take your time giving the money away. Next month, next year, even over the next decade. You are not locked in. And this is where bunching becomes powerful. Let me give you 2 examples. Imagine you normally give $20,000 a year. You could contribute $60,000 into a DAF in 2025. That's enough for 3 years of giving. You get the entire deduction now under the old rules, and then grant $20,000 per year at your own pace. Or maybe you want to be more aggressive. You give $30,000 per year and you are committed to supporting the same organizations long term. You could front load 6 years of giving, $180,000, into a DAF this year. That locks in a huge deduction under today's rules, and you completely bypass the adjusted gross income floor and the 35% cap that starts in 2026, because your deduction already went through. This is what I mean by proactive giving. Your generosity doesn't change, your tax efficiency does. And here's the thing, DAFs with Fidelity, Schwab or Vanguard can be set up in a matter of days. but they slow way down in mid-December, sometimes even earlier. Since we're already in December, don't wait on this. Give yourself at least a 2-week cushion. Now, if you are 70 and a half or older, there is a strategy one big beautiful bill act doesn't touch at all. Qualified charitable distributions, or QCDs. A QCD lets you give directly from your IRA, and the amount you give is not taxable income. It also counts toward your required minimum distribution. So if your RMD is $40,000 and you do a $20,000 QCD, your taxable income drops. Your Medicare IRMA risk can drop. The amount of your Social Security that's taxed may drop. And because you are removing money from your IRA without paying tax on it, you are slowing the growth of future RMDs. This is your most stable, tax-efficient giving tool if you're already taking RMDs. And for 2025, the limit is $108,000 per person, or $216,000 for a married couple if both spouses have IRAs. But QCDs take time. Custodians move slowly, especially in December. If you are doing a QCD this year, start the process this week. Waiting until mid-December is too risky. Let's shift to foundations for a moment. If you have a private foundation, or you are considering starting one, the year-end requirements matter. Foundations must distribute roughly 5% of their assets each year. Missing that requirement can lead to penalties and increased scrutiny. And with the new charitable deduction limitations coming in 2026, foundation oversight will only get tighter. So if you have a foundation, this is a good moment to confirm that your grants are on track. Your distributions are complete and everything is documented properly before December 31st. And finally, let's talk about the December timing trap, because this is where well-intentioned families lose the biggest deductions. A charitable gift only counts for the current year if it's completed in the current year, not mailed, not initiated, completed. This means checks must be cashed, not just written. Stock donations must be received and verified. Death contributions must be accepted by the sponsoring organization. QCDs must be fully processed by your custodian. And remember, everything slows down in December. Custodians, banks, mail, charities, everything. I've seen families lose a $50,000 deduction because a check cleared on January 2nd instead of December 30th. And I've seen stock transfers get stuck in a year-end backlogs and miss the deadline entirely. My advice? Initiate everything by December 15th. That gives you buffer for delays, follow-ups, and any unexpected issues. Alright, let me bring this all together with a simple action plan for the next 4 weeks. Step 1. Decide what you are giving this year. Cash, appreciated stock, QCDs, a death. Pick your vehicle now, not on December 28th. Step number 2. Run the numbers with your financial advisor or CPA. You want to make sure the deduction lands in 2025 and you avoid the adjusted gross income floor and 35% cap coming next year. Step 3. If you are given stock, initiate the transfer immediately. It takes 3 to 5 business days in perfect conditions, and a lot longer in December. Step 4. If you're opening a DEF, start the paperwork this week. Fidelity, Schwab, and Vanguard will bottleneck by mid-December. Give yourself a cushion. Step 5. If you are doing QCDs, contact your custodian now. The charity must cash the check by December 31st. Most custodians slow down dramatically in mid-December. Step 6. If you have a private foundation, double-check your 5% rule. Make sure all grants and distributions are completed before year-end. Step 7. Build in buffer. Have everything initiated by December 15th at the latest. That's less than 2 weeks from now. No exceptions. Because here's the truth. You are generous. You care. You give because it matters. But being generous and strategic, especially in a year like 2025, ensures more of your money reaches the causes you love, and less of it ends up with the IRS. And look, if you are planning to give this year and want to make sure you are doing it in the most tax-efficient way, whether that's donating appreciating stock, bunching through a DEF, using QCDs, or just timing everything correctly, I'm here to help. We can walk through your income, your investments, your RMDs, and your charitable goals and create a plan that protects your wealth and supports the causes that matter most to you. I'll drop a link in the description below where you can schedule a complimentary estate clarity meeting. Let's make sure you're taking full advantage of 2025 before these rules change. Now, if you want to go even deeper on this and see exactly which type of charitable gift actually saves you the most tax, cash, appreciated stock, or a QCD, I've got a full breakdown in this video. It's one of the most eye-opening comparisons I've ever done for retirees. Make sure to check that out.